Have you ever wondered how multifamily real estate managed to maintain its position as the dominant investment category in commercial real estate, even amidst policy uncertainties and shifting lending conditions? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In the second quarter of 2025, the multifamily real estate sector delivered a compelling narrative of resilience and growth, according to a report from CBRE. Multifamily properties captured a staggering $33 billion in transaction volume, representing 34% of total investment activity. Although this figure marked a 19% decline from the exceptional $40 billion recorded in the second quarter of 2024, largely due to Blackstone's $10 billion acquisition of AIR communities, there are still plenty of reasons to be optimistic. When we strip away these mega transactions, we see a 9.4% increase in single-asset multifamily investments, reaching $26.4 billion year over year. This signals a sustained appetite for apartment buildings and rental communities across the country. The sector's four-quarter trailing volume stands at an impressive $148.9 billion, a robust 21.8% increase from the prior year. This underscores the resilience of multifamily as an investment vehicle amid economic uncertainty. When we look at geographic hotspots, regional markets have shown significant variation in multifamily investment activity. For example, Las Vegas led with an astounding 377% increase in multifamily investment volume, followed by Kansas City and Seattle. These areas benefited from favorable demographic trends, such as population migration and employment growth, which bolstered rental demand. Interestingly, international investors have shifted their focus back to U.S. multifamily property in the second quarter, with $1.4 billion in inbound cross-border investment. Canada, in particular, remains the largest source of international capital flowing into U.S. commercial real estate, contributing $6.3 billion over the trailing 4 quarters, with significant portions directed toward multifamily assets. Lending conditions have also improved, boosting investment activity in the multifamily sector. Loan-to-value ratios for multifamily properties rose to 65.8%, indicating lenders' increased willingness to provide leverage. Government-sponsored enterprises, Fannie and Freddie, have played a crucial role in multifamily financing, with agency origination volume surging 43% year over year to $28.9 billion. The average agency mortgage rate fell to 5.7%, making borrowing more attractive for apartment investors and developers. Despite these positive indicators, the sector isn't immune to broader economic concerns. Policy uncertainty, highlighted by President Trump's tariff announcements, has introduced some volatility. However, the multifamily market remains well-positioned to benefit from demographic trends favoring rental housing, improving lending conditions, and its defensive characteristics during economic uncertainty. The Vancouver multifamily market is presenting some challenges to Canada's broader housing plans, according to a recent article by Wood Central. Despite the government's efforts to stimulate building through escalating subsidies and billions in tax incentives, building intentions continue to fall. Statistics Canada reported that the total value of building permits sharply declined in April, reaching its lowest volume in nearly a year. The residential sector saw the most significant pullback, with multifamily units dropping by 20.5% year over year, largely due to a $1 billion decrease in the Vancouver area. Interestingly, while building intentions for single-family homes were more resilient with only a 1.5% decline, the non-residential sector also faced challenges, with permits falling to $4.3 billion, a 13% decline from the previous year. Ontario, however, bucked this trend as government-backed projects provided a much-needed boost. This trend highlights the regional disparities in the housing market across Canada. Better Dweller, a Vancouver-based news publication, notes this slowdown despite frequent announcements and incentives from policymakers. It suggests that the state-backed stimulus might be becoming counterproductive, with more subsidies resulting in diminishing returns. This scenario underscores a potential inefficiency in current strategies to encourage building. The challenges aren't confined to Canada. The United States is experiencing similar issues with the spiraling costs of building a new home and fluctuating tariffs impacting the construction industry. The U.S. Census Bureau reported declines in spending on both single-family and multifamily homes. Redfin's latest report highlights how rising costs and economic uncertainty are causing many Americans to delay big purchases, despite a slight rise in median home sale prices. Now let's turn our attention to an inspiring story out of Boston, where Damian Szary and his company Redgate are making waves in the multifamily real estate scene. According to the Boston Real Estate Times, Szary, who co-founded Redgate in 2010, has been on a mission to redefine urban living with a focus on innovation, collaboration, and long-term thinking. This vision was born out of the 2008 financial crisis, and it has truly taken shape in the years since. Redgate's latest development, Gibson Point in Revere, Massachusetts, has been awarded the 2025 Multifamily Excellence Award. This project is a prime example of how Szary and his team are pushing the boundaries of what multifamily living can be. Gibson Point transforms a previously underutilized waterfront site into a wellness-focused residential destination, complete with New England's largest residential living roof, a thermal cycling spa, and a Zen garden. This development is all about sustainability and resident well-being, offering more than just a place to live. It's a lifestyle. What sets Redgate apart is its vertically integrated approach, which spans investment, advisory, and project management services. With offices in Boston, Bethesda, and Raleigh, Redgate is growing its national portfolio by combining institutional expertise with entrepreneurial execution. The firm is actively expanding its capabilities in asset management and strategic operational leadership, ensuring they're well equipped to navigate complex developments from vision to delivery. Damian Szary credits much of his success to his early career experiences, particularly working alongside Deb Gould, a top commercial broker in Boston. Her work ethic and deal-making skills left a lasting impression on Szary, helping him develop the confidence and framework to source deals independently. This mentorship, combined with his education in real estate development from Columbia University, has been instrumental in shaping his career and the success of Redgate. One of the most rewarding moments for Szary was Redgate's first project, Maxwell's Green, in Somerville. This development was one of the first multifamily projects following the 2008 financial crisis and set the tone for Redgate's focus on outer urban core developments. Szary emphasizes the importance of learning real estate finance and advanced modeling skills early in one's career, as this foundation allows professionals to see opportunities others might miss. Gibson Point is more than just a residential project, it's a testament to how Redgate and Damian Szary are reimagining community living. With integrated technology and concierge services offered through the Elevated Living app, residents enjoy a seamless living experience. Projects like these highlight the firm's commitment to creating exceptional places to live and work, embodying a forward-thinking approach to multifamily development. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.